The challenges that exist today in private markets make leadership and strategy execution more important than they've ever been. And all we care about is trying to unlock that puzzle for this entrepreneur. We call this strategy the Keystone strategy because the keystone animal is the animal in an ecosystem that helps the entire ecosystem thrive.
Thanks everyone for joining us for this month's edition of the CAS Third Thursday webinar series. This month I'm thrilled to be joined by Ian Charles of Arctos Partners. So Ian, great to see you and thanks for joining us.
Good to see you, Matt. Appreciate the opportunity.
You know, Ian, obviously the CAS network knows you really well, but they know you as something really different from what we're going to talk about today. They know you as a sports guy. So I think what would be helpful for the audience is maybe to give us a little bit of background on Arctos. How'd you get here? Why'd you get here? A little more on the Arctos strategy itself, or the Keystone strategy, and what's the theme that this is focused on?
When we started Arctos 6 years ago, our vision was to create a firm that serves markets that are not well understood, bringing rigor, analytics, and research and operating perspective to those markets, and then providing growth capital and liquidity solutions to great operators. We started by applying that equation, what we call an alpha equation, into the professional sports industry in partnership with you and a large group of institutional investors. And that's been an incredible franchise for us. About 2.5 years ago, we went back to our roots. Most of the founding team at Arctos didn't grow up in the sports and live entertainment industry. We grew up in the alternative asset industry, building and leading investment activities and businesses in really illiquid parts of private equity, in the secondaries market, secondary advisory, pref, GP stakes. And that combination of principal investing, advisory, and entrepreneurship is a very rare combination of skills. And when I personally was having the most fun in my career, it was helping the leaders of other firms unlock their most important thing. I got to apply all of the learnings and lessons of that activity in building Arctos with the rest of the founders and the rest of our team. But 2.5 years ago, we created a second strategy that we call the Keystone strategy. So we have the Arctos Sports product family, and we have the Arctos Keystone family. And the Keystone strategy is all about helping great operators who happen to be running private markets firms execute on their vision, unlock their most important thing, and lead their firms on the journey that just happens to be called, being the managing partner of another firm. And so the Keystone strategy is all about understanding private markets as well as anyone, using research and data science to understand where is the market going. How does where the market is going impact the competitive landscape for different kinds of firms? Within the firm, what are they actually really good at? Where does their alpha come from? How has that changed over time? How is where it's coming from likely to change over time? And based on where the leader of that firm is trying to take that business, how will the skills and competencies of the firm need to evolve to meet the competitive landscape in where they're heading? All of that boils down to strategy and leadership and execution inside of an investment platform. And we think the challenges that exist today in private markets make leadership and strategy execution more important than they've ever been. And our Keystone leadership team is focused on helping great operators who are leading great firms unlock their most important thing and create what we call organizational alpha. And so that's what our Keystone strategy is focused on, is building a portfolio of partnerships with great firms who aren't ready to sell permanent equity in a GP stake. That's a different strategy. It's a great strategy for the right time and the right kind of firm. The firms that we're focused on have some big opportunity or constraint that they want to unlock. They don't know exactly how to do it. It probably requires capital. but they don't want to sell equity forever, at least not yet. And so we form a partnership with those managers where they contribute a lot of really valuable assets. We provide the capital that will help change their organization. And then we participate in the realization of that collective package of assets in a disproportionate kind of senior position, downside protection, but importantly, self-liquidating structures. And so our investors know exactly when and how the portfolio is going to be monetized. And for our partners, the GPs that we've partnered with, they know that if they get to this really important endpoint, this really important destination, the upside is theirs because we're not a permanent equity partner of theirs. And so that's the opportunity that the Keystone strategy is focused on. Private markets, great managers, unlocking a really important thing through a self-liquidating security as opposed to permanent equity.
Super helpful overview. One of the things you mentioned in there was downside protection, and you've known us for almost 6 years at this point. That's where we start everything.
Yeah.
So tell us a little bit about where the downside protection comes from in terms of structure, how you build it in, and how it's just overall part of the Keystone process.
Before we talk about like deal structure and downside, I want to double click into our process a little bit more so people understand exactly kind of what we're doing. Every deal that we do is different because every firm is different. Every firm's path and journey are unique. Their leadership team is unique. Their investor base is unique. And so when we get introduced to a manager, it's almost always because there's some really important thing they can't figure out. It's an opportunity, it's a constraint, and they just don't know how to unlock it. And these are really sophisticated, really smart entrepreneurs. But in these businesses, it's a pretty lonely gig. It's not an apprenticeship business. There's not a bunch of really successful founders that come back and mentor new entrepreneurs that started firms. When you start a firm, you're usually a deal junkie that got frustrated at a big shop. And so you put your shingle out. You and a couple of colleagues started this thing. We call those founder businesses, and there's thousands of them. They have fund 1, fund 2, maybe they're on a fund 3. There are literally almost 4,000 founder-led businesses in US and European private equity. Once those businesses start to mature into a real business, real cash flow, they start to diversify into products, generational leadership, and the businesses start to become pretty complex. And there are about 2,000 what we call firms that have graduated out of that founder-led category. And a lot of them are trying to make it from firm to franchise. And a franchise in private equity is a business that is so established and so strong, there's no real key man risk in that business. There are probably about 75 franchises in developed market private equity. And so the chasm from firm to franchise is vast and it's intimidating. And there's no manual, there's no playbook. You can't go to some kind of weekend MBA course. There's really no one serving the leaders of these firms when they hit that really hard thing, that really important unlock. When it gets to us, we obsess about that thing. And all we care about is trying to unlock that puzzle for this entrepreneur. And if that unlock is accelerated, de-risked, amplified with capital, that looks like a deal opportunity for us. Okay. But this thing is so important to them that if you unlock it, it's going to create tremendous value for their organization. The last thing we want to do is take a permanent piece of that value and have them resent us for the next 15 or 20 years, or their next generation of leaders resent us. And so what we think is really important is to design a deal structure where as they are successful in achieving their goals, we liquidate out of that partnership and leave them with the upside. That's a really important part of our thesis and our strategy. So when we do a deal, We're partnering with a manager that we believe mathematically is great. We believe in their vision, and we believe in the plan to unlock their vision. And we have designed a partnership where they're going to contribute management fee revenue, profits from their business, some of the commitments they've made to their older funds, carry from their older funds. A lot of the things that they might sell in a GP stakes transaction, instead of selling them, they contribute them into this partnership. And sometimes they contribute 2 or 3 times as much into this partnership as they might sell in a stakes trade. And into this partnership, we will fund the capital required to unlock the opportunity or constraint. Now we have this partnership with this manager, with this company, and we take a senior position and we cash flow our way out of that partnership over time. And we have a lot of confidence in that structure and our alignment with the manager, because if they're really successful and things turn out to be a lot better than we thought, the things that they contributed will be more valuable faster, will burn out of the security, and they'll be really excited to partner with us again someday. If things get really hard because of the market or because of the execution, we sit senior in the structure and we keep participating in those economics until we've earned a minimum level or minimum threshold return. So with that setup, we have downside protection, over collateralization that is designed to provide our investors with really attractive yield and a fully liquidated return profile much faster than you might see in some other strategies. So how does that break? That breaks if the things that they've contributed fail, they erode in value massively, and if the thing that we've funded into the partnership also breaks. As long as one of them doesn't fail, we'll get a high single digit, low double digit return. If they both fail, principal might be at risk, but that's a really rare thing. Because if a firm is contributing management fee streams, those pay. You guys are experts in the value of management fee streams and their dependability and their durability. I mean, that's an investment grade credit, right? The profits of their firms, which is a huge lucrative part of their personal wealth and payment. Carry from their older funds, GP commitments for their older funds. If those things stop generating cash flow, we've all got bigger problems, right? Something massive has broken in the capitalistic system. If the thing that we funded, which might be a new product, it might be a balance sheet for the firm, it might be GP commitments, it might be the acquisition of another firm. If the things that we fund break, but the assets that have been contributed perform, we're okay. So for our investors in a single deal to have principal at risk, you need the assets that have been contributed by this established, successful business that we believe mathematically is excellent at what they do. The things that they have contributed have to erode in value massively. And the things that we've helped them invest in that they viewed as really important also have to fail. And that requires a combination of market failure and operator sort of company failure that is highly unlikely. It is possible, but even in those scenarios, our downside return profiles about a return of capital. Does that answer your question?
Absolutely. One of the things you alluded to in there was that the difficulties in private markets can be a significant challenge, right? And
Yep.
I've heard a lot from Arctos around private markets lately. I think you guys do some of the best research out there on private markets. What is the biggest headwind that exists for Keystone and for private markets right now?
The biggest headwind for private markets today is the maturing of our industry. The language that we use to summarize some of our work around this area is what we call the twin scarcities. Today, for most managers, capital is scarce. It's hard to raise capital. for most managers, it's also hard to originate alpha generating opportunities and realize alpha. It's really unusual for capital to be scarce and for alpha to be scarce. Usually when there's no money, there's a lot of really attractive deals to do. Or when there's too much money, there's no attractive deals to do. It's weird that there's a deficiency in both. But we think that's a sign of two things. One is the maturing of this market as an industry. They went through a hyper growth phase for 20 years. And now, through that maturation, if you want to continue to grow as a business, as an operator, instead of riding that wave, that beta wave, you actually need to compete and take share. And that's hard because that means you have to convince the customer you're the very best at what you do. You need to clearly articulate your right to win, how you generate alpha, how durable and repeatable and scalable is that alpha equation. Most managers are not very good at that. Most managers don't even know if they really are an alpha generator. And we have some of the most sophisticated software and services to help the leadership team of great firms understand how great they are, why they're great, how that's changed over time, how it's likely to change based on how they're trying to lead their business. And that's a whole set of services that we use to help unlock the right journey to achieve the vision. The other big challenge for the market, other than maturation, is valuation. We think most assets across most sectors in private and public markets are at valuation levels that do not provide for an attractive mathematical expected return. This is not a private equity thing. We think this is true in public equities too. The valuations are stretched across all kinds of US equity strategies. When you combine those high valuations with more normalized costs of capital from the debt markets, right? People complain about the cost of debt all the time, but it's not that different than the cost of debt in the 90s. And there were great LBOs to do in the 90s. But back then, the entry prices were a third of what they are now. And so when you have elevated valuations and more normalized cost of debt, it's hard to find mathematically deals that work in the traditional LBO model without assuming a tremendous amount of value creation, which is pretty hard to justify across the entire industry. It also makes it hard for sponsors to sell to each other and for strategics to buy. If the valuation on your books is a little bit too high, it's hard to cross a trade without writing it down at exit. And in fact, over the last 15 years, if you look at the data on the value at exit relative to the holding value just 2 quarters earlier for private equity exits, it's always been 20 to 40% higher. Businesses get sold at a premium to their holding value. Over the last 2 years, the aggregate realizations have been down relative to their holding value. To move assets and sell them, the market is selling them at a small write down. They might still be great deals, but they're being sold below their carrying value. That's a classic sign that valuations are too high. And so the market right now has a little bit of it's seized up a bit. Capital formation's hard. Realizations are hard. New deal origination is hard. And to break out of that constraint, you've got to be excellent at what you do. And there are excellent firms trying to do really incredible things, but there's a lot of firms that aren't excellent. And the maturation of our market is going to settle that out. There will be winners and losers. And one of the things I'm most excited about is the market's never gone through this phase before. And so firms that have leaders who are strategic thinkers, who are good at managing talent, who understand where value creation through the investment process happens, and they have built something special, they will be rewarded. And that's the first time in our industry that there will be this kind of shakeout between those really great investors who also happen to be led by great entrepreneurs, and what we call sort of beta wave riders.
So you think about all those market dynamics, and my question for you is, it plays into Keystone strategy, right? You obviously sort of purpose built the strategy for where we are. So what dynamic does it create for you that is a tailwind for Keystone specifically? All of those unique things going on, how does that play into what you're trying to do?
Yeah, look, I also want to make sure I don't come across like a Debbie Downer here, right? Private markets are really important for institutional investors and for high net worth investors, because you can generate alpha in these more inefficient, more illiquid strategies. And alpha becomes more critical in environments where valuations are high, where you need the alpha to hit your return objective. Alpha is most plentiful in private markets. The key is aligning yourself with managers that have clearly demonstrated alpha creation and have a repeatable, scalable machine and process that will allow you to harvest alpha going forward. For Keystone, we have some of the most sophisticated assessment tools for identifying those managers that do generate alpha and understanding how and why they do generate alpha. And so we're already able to isolate out the best of breed in each kind of segment of the market. And we know when we're working with one of these firms that they are great at what they do and they do generate excess return for their investors. So we've already self-selected into the best part of the market. And we're helping them unlock something that is really, really important to their business, to their team, to their people. Again, we call that unlock organizational alpha. And we help them unlock organizational alpha. In exchange for that, they let us harvest our own investment alpha for our clients. And the way we deliver that is through a portfolio of these really unique partnerships that self-liquidate, that have seniority, on top of a big pool of really attractive assets managed by these great GPs. And that portfolio generates really attractive cash flow, risk return characteristics with downside protection in a market where those things are really hard to find, outside of maybe sports.
One of the things I think about when I think about the Keystone strategy, and I want you to correct me if you think I'm wrong about this, but when I think about it, one of the most attractive things is a narrowing of outcomes, right? It's a narrowing of the bands of potential outcomes that can happen.
Yep.
Where does the upside come from in a Keystone deal? Is there upside that is not built in and obvious to us maybe?
Yeah, the narrowing that you talk about, I completely agree with it, but the narrowing is on the multiple of capital. The Keystone strategy is not a 10x strategy, but I don't know, outside of early stage venture in the right moment in time, I don't know many that are. Where we have real upside is in duration. Where we have real upside is in the IRRs. Because if we can deliver that, but we do it with a cash duration of 3 years, because the market does unlock, the market does start to return to some normalization in fundraising, or some normalization in realization, or in a super upside case, both, where the things that have been contributed by our partners become really liquid and really valuable fast, and the things that we've helped them build and fund become really successful fast, our IRRs shoot through the roof because we have this senior position in this structure, and we get liquidated out of the structures quickly. So we have this unbounded IRR upside, but this really constrained downside IRR and MOIC potential. And the mathematical term for that is convexity. And so we have convexity in each deal and convexity across the portfolio that rewards our investors in a wide range of market environments. If the market is hard and it gets harder and liquidity dries up, we're protected in these structures and we just keep compounding and growing. On the flip side, if things get a lot better than we thought, your IRRs shoot through, right? Your MOIC might come in because your duration's coming in, but your IRR is just incredible and the cash is coming back fast to the investors.
We think about that upside and certainly the downside. You've been involved in private markets and a student of private markets for a really long time. How do you think today, on a scale of 1 to 7, how does today's environment set up for the Keystone strategy, with 7 being just through the roof, best possible thing out there, to 1 being, I'd like to tell you it's great, but acknowledging it's definitely not great?
I would love to know how many managers ever answer that thing with not a 6 or a 7. I'm a big believer that things are never as bad as you think, but they're also never as good as you think. So I would actually probably never answer that question with a 1 or a 7. I think the market environment for the average manager today is hard. It's probably a 3, right? For a great manager with great leadership, it's a 6, because the market is starving for what you can provide them. What you can provide them in the form of alpha is more important today than it's ever been in private markets. And so if you are one of those managers, it's a 6. And our strategy is backing those managers in their most important thing, right? And so for the execution of our strategy, I believe the Keystone strategy today in your framework is a mid 5 to a low 6.
Last question for you. I think Keystone is a strategy that is unique out there in the marketplace. It's not one a lot of other managers have seen. It's not one a lot of investors have heard or potentially understand. So what I'd love to know for the audience is, what do you think is the most misunderstood aspect of the Keystone strategy and the theme that it's focused on?
I think the thing that most people don't understand is not really about Keystone. It's about private markets. People have a hard time accepting that the asset manager, the GP, it's a business. It's a people business, but it's a business just like any other business. And the leader of that business probably never got trained in management, right? They're a deal junkie, they're an investor. And as they get more successful, the management of the business gets more important, but it gets harder because the business gets more complex. And that journey leading these businesses, it's hard, it's pretty lonely, and it's daunting because you have so many stakeholders. Each of your investors and their stakeholders, each of your employees and their families, each of your portfolio companies and their stakeholders and their families. And so as this really cool little idea you had as a founder blossoms into a firm, all of the anxiety you felt from the entrepreneurial journey gets replaced with this stewardship anxiety. You don't want to screw it up. You want to unlock its full potential. And that's really, really hard because no one is really serving the leader of these firms. And that is our advantage and our edge, because we are entrepreneurs who have built businesses inside of private markets. We have built private markets firms, and we can relate to the leaders of other firms. At the same time we relate to them, we bring this really comprehensive, beautiful suite of analytical software capabilities and a framework and an operating system for them to understand not only their business, but also their competitive landscape and where they're trying to lead their firm. We give them a language to run the business if it's helpful. And I think the unique thing about Keystone is that we see that need to serve the entrepreneur, and we have the experience, the capabilities, and the strategy to serve. And if we can serve, we can help great firms do great things, And that's where the Keystone name comes from. Maybe I'll end with that. We call this strategy the Keystone strategy because the keystone animal is the animal in an ecosystem that helps the entire ecosystem thrive. And that's what we want to do. We want to help great firms thrive.
I think that's a fitting way to bring it to a close. So, Ian, sincere thank you for joining. I always enjoy talking to you. I think this was super educational for the audience, and I really appreciate it.
Listen, Matt, we're grateful for our partnership with CAS. We're grateful for our partnership with all of your clients, and I appreciate the opportunity to share our story with you guys today.
Thank you, my friend, and thank you, everybody, for joining us.